Hey everyone, welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show this week, a lot to talk about. Today's show is sponsored by my friends at YCharts. YCharts is an awesome data analytics and charting platform. Take a look at the show notes for a link to a free trial to YCharts and 20% off when you first sign up for the service. So first thing I want to touch on is the equity markets and when you see the biggest bounces. So we talked about last week, we had this unusual situation where only 2% of stocks in the S&P 500 were above their 50-day moving average. So it's something that we call in technical terms extremely oversold. And what does this mean in layman terms? Well, it just means almost all stocks are going down at the same time. And when you have the situation where almost everything's going down together, you have the tendency for a snapback in the other direction. So what we see historically, as we talked about, following these extreme oversold conditions is actually above average short-term returns going forward. And thus far, we've seen just that. We've seen a little bit of a bounce, 7.6%. Nothing unusual. We've seen a few of these bounces before this year, only to see lower lows ahead. Same thing could happen this time. We don't know. But I think the broader point here for investors is, when do you see these big bounces? And what you tend to see if you look back at history, you see the biggest bounces in markets most of the time during bear markets, not bull markets. And if we look at two charts here, it really illustrates that. Top one is 2000 to 2002 bear market. The bottom one is 2007 to 2009 bear market, both 50% declines in the index over this period of time. Then you look at the bounces and you see there are many of them, and they're pretty large. You can have a bounce that's 5%, 10%, 20%, or even more. And it happened a number of times throughout these bear markets. And the lesson here is that markets don't move in a straight line. They go from point A to point B, but there's a lot that happens in between. It's not a straight line between A and B. And when you have these sentiment extremes, you have these oversold extremes, you can have the market bounce. And the bounce doesn't have to mean that the bear market is over. You can see lower lows ahead. But why are these occurring more often during bear markets than bull markets? Well, simply because of volatility. Volatility is higher during bear markets. If you look at the VIX, that's a measure, one way to measure volatility. But the VIX doesn't just tell you about downside volatility, which is what we normally think about. It also tells you about upside volatility, at least the potential for it. So it's a swing in either direction of the market. And so when you have a high degree of volatility, the market's going down a lot in a particular day or week, well, you can see the same thing on the upside. And so what we're seeing recently is just a manifestation of that, is that the market volatility has been very high in recent weeks. So not unusual to see high volatility on the upside, coming off of that. So the question, of course, that you're probably wondering is, well, how do I distinguish between these bounces that were only followed by further losses and the bounce that was the end of the bear market? So we had this bounce in October 2002 and March 2009, marking the end of the bear markets. And how do I know when that's coming? And unfortunately, I can't tell you that. No one can tell you that, because there's really no distinctive behavior that differentiates between the two. There was nothing about that bounce. Some people will tell you that there was, but there really wasn't anything different about those bounces that lead you to believe that the bear market was finally over. And same thing with today. And what we've seen over the past week is simply a bounce. And we'll only know in hindsight. We'll only know, of course, when the S&P ultimately hits a new all-time high again, whether that was the bounce to end the bear market. So could it be? Yes. Does it have to be, as we've seen? Certainly not. And so, speaking of all-time highs, how long will it be before the S&P hits all-time high? And of course, in recent years, we've been spoiled with all-time highs. Last year being kind of the ultimate of that, where we hit 70 all-time highs in the S&P 500. which was the second most of any year in history. Only 1995 had more at 77. And we've just seen a number of consecutive years here since 2013 where the S&P 500 is hitting a new high every single year. And so we only had one this year that was in that first week, that peak in the market. The question is it going to be a situation where we come back like we did in 2020 and 2018 and 2011, where the bear market is relatively short-lived and we have a sharp, fast recovery back to new highs? Or is it going to be more like those bear markets that we talked about, like 2000 to 2002 and 07 to 09, where the market peaked and then went years without a bear market? Where we are today, it's hard to kind of argue one way or another. We're down 24.5%. And in terms of the number of days, it's not even the longest correction that we've seen since March 2009. So we had a longer correction in 2015, 2016 than today, although the decline wasn't as big. So anything is possible at this point. It could still be a short and shallow bear market, but every day kind of that it goes on, of course, the likelihood of that kind of goes down. And as the declines get bigger, it's harder to recover from a bigger decline quickly. So I asked investors, what are you thinking in terms of this? When do you think we'll see a new all-time high in the S&P 500 again? Some interesting results here in the poll that I put out. 8% said this year. So very few people thinking that the S&P 500 is going to have that V-shaped recovery like we saw in 2020. Many more people seem to believe that it's either going to be next year, the year after, or even 2025 or later. So why are people kind of pessimistic? Well, you're always pessimistic in the midst of a decline. There's a lot of bad news out there, of course, and investors, I think, are most concerned about inflation. They're most concerned about Fed tightening policy, mortgage rates going up. They're most concerned about all of that backdrop. And they're thinking, well, if we're possibly heading for a recession here, and maybe we're already in one, as we talked about, a lot of people think that we're already in a recession. How could the market possibly have a V-shaped rally back to new highs? And the disconnect, of course, is that the stock market is not the economy. The stock market will start going back up again long before the economy starts improving. And anything is possible in markets, as we saw in 2020. So I don't think anyone would have thought in March 2020 that we would see a new all-time high that year, but that, in fact, was what happened. So it could be that scenario again, or it could be investors are right in this case, and it's going to be multiple years without a new all-time high. And that wouldn't be, as we've seen, unusual at all. What we saw, if anything's unusual, it's what we saw last year, where a few times a week, the market's hitting a new all-time high with very little volatility in between. So speaking of volatility, history, as often said, may repeat itself. May not repeat itself, but it often rhymes. And I like that saying because that really applies to markets. We don't look at market history expecting a repeat of the past, but there are similarities at certain points in time that can give you context and give you an idea of the possibilities of what could happen in the future. And one example, I think, important one that we saw last year and that I wrote about was the Bitcoin situation in Bitcoin, and specifically what we saw in the fall with the trading of the first Bitcoin ETF. So we had this parabolic run up last year in Bitcoin, more than tripling into the fall last year. And at the time, investor sentiment is extremely bullish. Very few people thinking about downside. And you have this product that is meeting that high level of demand, which is the first Bitcoin ETF. So that by itself probably doesn't tell you very much, but within a few days, this ETF crossed $1 billion in assets. So that was the fastest ETF ever to cross $1 billion. And the speed at which it did that, with the backdrop of just enormous gains on the year, told you, let's look back at history for some type of parallel. And 2017, as I wrote about at the time, was really the best example we could come up with, where Bitcoin had a similar parabolic run up. Investor sentiment was very similar in terms of irrational exuberance. And Bitcoin futures, you had a product that started trading at the time to capitalize on that demand. Bitcoin futures start trading. And what happened, of course, after that was a pretty sizable decline and a reversal in a good part of the gains from that year. And so last year, the caution that one might have had in looking at that parallel is to say, well, this is a possibility of at least that could happen, but maybe don't go crazy into crypto at this point, or use leverage, or take a lot of risk because all the signs are there. We can't predict the potential top, but all the signs are there that a big drawdown, a big correction is possible. Right. And so what I was tweeting out pretty much every week last year, when we were hitting new all-time highs in the 50,000, 60,000 range last year, was this table here showing you historical corrections in Bitcoin. And a lesson for Bitcoin investors last year was simply look back at history. We had 90% declines, 80% declines. This run up was not risk-free. And so this time is not different. You don't get all of these gains without the possibility of loss. You don't get all of this reward without risk. And so risk hasn't been eradicated. Therefore, it's just been delayed, and it's coming, and be prepared for it when it comes. So now we're in the midst of it, 74% decline. Nothing remarkable. In a historical context, Bitcoin could certainly come back from this, as it has come back from 80% and 90% declines in the past. But the lesson for investors is that the two go hand in hand, and you cannot have just huge gains in an asset classes without that downside. And so I would contrast that situation with something like a stable coin, as I've talked about, and I don't want to rehash everything with Terra here, but Terra US dollar is a stable coin that was supposed to trade at $1, and it's promising a 20% yield with no volatility. And so what investors have learned throughout history is that if something seems too good to be true, then it is too good to be true. And this is really the latest example. And unfortunately, for investors in the stable coin, they had to learn that the hard way. So let's move on to something that I think deserves a lot more attention than it has gotten. I don't think it's gotten really any attention at all. It's what I've called the worst trade in history. And I don't make that statement lightly. I believe it actually is the worst trade in history. And it's at the same time been to the detriment of the American investor to the tune of tens of billions of dollars. So what am I talking about here? Well, first, let me just give you some backdrop. In late February, NYSE and NASDAQ decided to halt trading in Russian securities. And it didn't seem remarkable at the time. We had just announced extreme sanctions on Russia because of their invasion of Ukraine. There was regulatory concerns, liquidity concerns. The Russian stock market was closing, and these exchanges were saying, well, we can't simply allow trading in these securities anymore due to all of these issues. The big one being, we don't know, with regulatory uncertainty, we don't know if we're even going to be allowed to be transacting in these stocks anymore. And so trading was halted at that time, and it has never resumed. And no one, I don't think anyone's expecting it to resume anytime soon. But this had a huge impact because there's a decent amount of money invested from U.S. investors in Russian securities. So $68 billion in stocks. Then you have Russian bonds on top of that. So you're talking about tens of billions of dollars invested in Russian securities from U.S. investors. And that's a broad range of U.S. investors. So pension funds own this, endowment funds, 401k investors, IRA investors. Many of them likely don't even know they had exposure to Russian securities because they hold them through mutual funds or ETFs that have Russia as part of a bigger index, either a global stock market index or an emerging market index. Russia is some percentage of that. So unbeknownst to most people, because the market was falling overall at the time, they likely didn't notice anything extremely different, because the market was going down general, and Russia's only a small percentage of the overall total market, let's say, index. But if you owned Russian securities directly, either on the Russian exchanges or ADRs trading in the US, you likely noticed something going on here in late February, early March, was essentially a crash in the securities. So these are the 6 largest Russian companies. And I wrote at the time, it was just a stunning collapse, like a multi-standard deviation move in the securities in a 2-week period following that invasion of Ukraine. So 70, 80, 90% losses in these ADRs, anticipating that there was going to be either a trading halt or a delisting or something more, a ban on U.S. investors from buying it. And what ended up happening was, as we saw, a trading halt was initiated in late February, and all of these things. Then there was no liquidity, there was no trading in it. If you hold these things, it's still not clear what's going to happen to them, but it's not likely going to be a favorable outcome. But for most investors, they probably didn't have exposure directly in buying these individual stocks. You likely had it within a fund, either an ETF of Russia itself, which wasn't that large, but more likely an ETF that tracks the emerging market index, or again, a global international type index or a total world type index, where Russia is some percentage of that. So in the emerging markets, it's let's say 3, 4, 5% of that, depending on the index. And in a global total market portfolio, it's even less than that. So you wouldn't have noticed it necessarily. But what actually happened was that these major index providers, MSCI, FTSE Russell, and then S&P Dow Jones, in a series of days, they decided to essentially cancel Russia and remove Russia from their indices. And that might not be surprising, and you might say, well, that's good, they shouldn't remove them. What was surprising was that they decided to do so when the Russian stock market was closed, and they decided to do so at a price that was effectively zero. And so all of these funds, ETFs, and funds that track these indices, in turn, started to sell off these securities or write them down to zero, and sell them off at pennies on the dollar. And so this is one example where the iShares MSCI Russia ETF, if you look at their year-to-date NAV, it's down 99.81%. And if you look at the percentage of cash that this ETF now holds, it's almost all in cash. So the sales have been made. They were made during that week, mostly in that week in March, and at prices that were, again, effectively 0 pennies on the dollar. And why is this what I call the worst trade in history, and really a fleecing of the American investor? Well, it's because these securities are not actually worthless. If they were worthless, I don't think anyone could blame them. But if we look just a few weeks after they did this, the Russian stock market started trading again, and the securities in the Russian stock market started to go back up again, and to the point where pretty much back to where they were before the point where Russia invaded Ukraine. This is one Russian index of Russian stocks. It's down only 11% year to date. And so someone might question this, saying, well, this is denominated in rubles and not dollars. And if an investor, U.S. investor, likely didn't hedge out their exposure, and they would have been hurt, if not from the price depreciation, then the depreciation of the ruble. But there too, if we look at a chart of the ruble, we've seen a complete turnaround, where initially there was a collapse in the ruble, and since then it's actually gained in value to the point where it's actually the best performing major global currency against the US dollar this year. And so what's going on here is Russia is benefiting from the commodities boom that's gone on, and they've certainly benefited more because of the sanctions in terms of cutting Russia off from global trade. They've benefited because that drove the price of commodities up even higher. And if we look at Russia's current account surplus, we can see the effect of that up 95 billion in the first 4 months of this year, up from 27.5 billion last year. And so who's buying from Russia? If the US isn't buying and Western Europe isn't buying from Russia very much anymore, well, it's other countries that have decided to remain neutral in terms of the conflict. And if we look at the two most populous countries, China and India, they both have been buying Russian commodities at discounted prices. And so not only are they getting the much needed commodities to run their economies, but they're doing so at lower prices. So contrast that with the actions that the US took, which is essentially wiping tens of billions of dollars off of investors, US investors that were invested in Russian securities, dollars that are never coming back because, again, it's essentially gone. And the fact that the Russian stock market has recovered has no bearing on it because the securities are not in the portfolios anymore. Contrast that type of policy with what's going on with China and India in trying to do what they believe is best for their people and buying energy here at a discount. So very different policies, of course. And I think that more attention should be given to what's gone on here and who did they sell these securities to at these prices of pennies on the dollar. Was it in fact the institutions within Russia or around the world, the very institutions that were trying to hurt? Do we end up helping them by essentially relinquishing or selling our interest in these companies for nothing? And so that's a question I think that should be asked. And the lesson here is when you do something unilaterally without regard to consequences, you don't think it through, there can be unintended consequences. And here I think is a very good example of why you shouldn't rush to make any sort of policy decision based on the emotions of the day. So that if we rewind and go back to that period of time, there was just an immense push by the media and everyone within the US to essentially cut all ties immediately. It's like nothing. We had never seen this before in history without any regard to how it would hurt not only the American people, but the world. And as I've talked about, the impact that's gone on in terms of food prices, and we're just starting to see prices come down a little bit. So that's good news. But the impact on other nations is going to be huge for the remainder of the year, not just other nations, but the US as well. So let's move on to the housing market. I want to just touch on this briefly because I've talked about it a lot in recent weeks, but it's really the big story that's going on for many people within the US is observing this and kind of wondering what's going on here because we keep seeing prices continue to go up, but affordability go down. So here's the latest example. Existing home prices went above 400,000 for the first time in history. And at the same time, you have mortgage rates at their highest levels since 2009. So how do we have this type of disconnect where affordability is plummeting and prices are still going up? What's going on here? Or shouldn't we be seeing a slowdown in the housing market? Well, as it turns out, we saw something similar back here in 2005, 2006, where initially you keep seeing prices go up, but what you do see is transactions go down. So if we look at existing home sales, sales have really plummeted now in recent months, lowest level since June 2020. And so sales activity is going down because I believe the demand side has really collapsed. And so where are we seeing the biggest impact on the lower end of the market? So if we look at year over year changes in sales, it's hitting really the lower part of the housing market much more than the upper end housing market, which is still showing year on year gains. And why is that? Well, it's because the lower end market is more impacted by higher mortgage rates. There's more of an impact from the higher mortgage rates because they're more dependent on mortgages to finance the purchase of their house. They're also hit harder because just inflation in general hits people with lower income more. And so you have rising food prices, rising gas prices. That's going to hit people with lower incomes much harder than people with higher incomes. So is the upper end of the market immune? Are they going to see continued gains and so on and so forth? I don't think so. It's just going to be a little bit of a delay. So you can't change the reality of the housing market, but long term, it has to be the average house has to be affordable to the average person. And today, it's just not. And so as long as you have that disconnect, you're going to have this imbalance between supply and demand. And that imbalance could be corrected in one of two ways, either through time, or it just takes years, or through price, with price adjusting to become more affordable based on people's incomes. So let's talk about travel. This is something interesting that I've been observing and talking about is prices are going up still in terms of travel and going up very fast. If you've been looking at airfares recently, you likely noticed that they're going through the roof, highest airfare prices we've ever seen, and 38% increase over the last year is the largest increase we've ever seen in history. And at the same time, people are still traveling. So we got 2.3 million on average travelers, airline travelers in the US over the last week. That's the highest we've seen since the start of the pandemic. So how is that possible? How are they still traveling if prices are going up so much? Well, as we talked about last week, there's one of two ways that people can deal with inflation. They could either pull back in spending, or they could save less and start using more credit. And thus far, we're seeing the save less, more credit, and the point where they shift to thinking about a pullback is the point where a recession really becomes real. And so to a lot of people, we're already in a recession, but they're not behaving at it as if we are just yet. So when they make that shift to hold off on the trip, to hold off on the weekend drive because of gas prices and so on and so forth, when they really pull back in terms of discretionary spending, and maybe they already have, and we'll only see it in the data in the months to come. But in terms of the activity, in terms of the travel activity, we're not there just yet. It seems like there's still enough pent up demand to at least push us higher throughout the summer. So we'll watch this pretty closely. I think that the airfare is an indicator of what what consumers really they can ignore for a long time, and they can do so because they can adjust their savings and their credit habits in the short term. But in the long term, if prices stay elevated, I think people, given where consumer sentiment is, it's going to likely lead to a pullback in demand. So similar to the housing market, at a certain point, there is a breaking point in terms of demand where activity is going to go down. And so we don't know that point. $5 gas might be it. We don't know just yet. Maybe it'll take $5.50 or $6 gas. But at a certain point, you're going to see demand destruction. And ultimately, that may be what we need to bring down inflation, as we'll talk about in a little bit. But first, important topic concerns the Fed. There's been a push for the Fed to become more political in recent years, and they certainly, as I'll show you, have become more political. But there's really been a push from the House to really codify this. The House and the White House has really pushed for the Fed to become really an extension of the political party. And traditionally, this has not been the case. The Fed has been an independent body as much as they can be. The mandate from Congress since 1977, it's a dual mandate, the focus on price stability and maximum employment. So those two things. And the Fed's job historically has been to try to balance these two mandates while maintaining low inflation. Their target has been 2% per year. Obviously, we're well above that today. And maximum employment, and we can debate what that is. And today, the unemployment rate, some might suggest, is we're at maximum employment because the unemployment rate is so low. But historically, the Fed will try to set policy, and I would argue they haven't done the best job at this, but the Fed will try to set policy to balance these two risks. So if we're in a recession, typically the Fed worries more about the employment component because typically inflation rates come down during a recession, and the Fed uses stimulus type measures, loosens monetary policy, and you tend to see the opposite at the tail end of expansions, where inflation becomes more of a concern, employment is less a concern, and the Fed starts tightening monetary policy. And of course, that's the situation we're in today, where we have a very high inflation rate and a low unemployment rate. The Fed is tightening and expected to continue tightening until inflation gets under control. And as that balance shifts, the Fed will shift their policy. But all this, if the House gets their way, will change under the new mandate. So the House passed this bill called the Federal Reserve Racial and Economic Equity Act. And so the word there, two words obviously should jump out, racial and equity, because anytime these words have been used in recent years, they've been used, I would argue, not for good things, but for nefarious reasons. And those reasons are to insert race and race-based policies wherever possible, whether it's in education, employment, and now here with the Federal Reserve. The goal with certain groups within the political spectrum, obviously the far left, is to insert race wherever they can. And the agenda here is pretty clear. They want the Fed to use monetary policy, in a manner, they say, to foster the elimination of disparities across racial and ethnic groups. And as benign as that sounds, and some might argue, well, why wouldn't you want there to be no disparity? And the problem, of course, is the way you get there. And the way they always argue to get there is not simply by bringing everybody up, but by creating policies that benefit certain racial groups and may hurt other racial groups. So picking and choosing winners and losers based on race. And historically, that hasn't been a good thing. That's a violation, of course, of the Constitution, the 14th Amendment and the Equal Protection Clause. But beyond that, do we want the Federal Reserve to become an extension of one political party? So I would, if you agree with this line of thinking that the Fed should be concerned with this stuff, I would question, would you similarly agree with it if instead of talking about racial preferences, we were talking about gun control, or helping the Second Amendment, or some issue that was that the political right was concerned about? Would you be equally as supportive? And if you aren't, then if you wouldn't be, then you're not being honest in saying that this is a highly political measure that really doesn't, that a central bank it shouldn't be in their purview. If you want Congress to pass these types of laws, they should debate it out and pass it. But to have the leading bank of the country that sets monetary policy and regulatory policy, for them to be having this type of thing, certainly I don't think you can argue with a straight face that would be a good thing. And so there's a lot in this bill. I encourage everyone to read it and form their own opinions. But it's not just that the Fed should use monetary policy to try to eliminate so-called disparities. It also sets up a minority bank deposit program. So again, using race as a reason to allocate funds. So they're saying expanded use among federal departments and agencies of these minority banks. So if you establish yourself based on race, right, an immutable characteristic, if you establish yourself as this type of institution, you're going to get preferential treatment if this bill were to pass. And also it has, of course, big regulatory oversight. So every institution that the Fed regulates is going to get this diversity and inclusion rating. And the terms again sound benign, but whenever they're used together, whenever that word inclusion is there, they always mean to the exclusion of someone else. So it's never simply, again, bring all Americans up. It's always favoring certain groups based on race, which we should all condemn. And if it was the reverse situation, we would certainly condemn it. So this particular bill talks about giving each institution this diversity and inclusion rating. And specifically, it talks about having to have a diversity and inclusion officer at every depository institution. In addition to that, it says that these minority depository institutions will automatically be given the most favorable rating with respect to this diversity inclusion. And these institutions are exempt from any examination procedure. So they're saying that it's so important that they have this rating, which is going to judge institutions based on their hiring practices. So again, probably counting the number of people of different races that these institutions hire. And if it doesn't match up with what they want, they will assume that there's some type of discrimination going on, and they will use so-called reverse discrimination, which is still discrimination, to right that wrong. And so they're going to exempt institutions based on race from these ratings, which on its face, of course, is racist. They're treating different races differently based on their race, and that should be wrong to any American. And the Fed, of course, should be focused on what's going on in the economy and the inflation picture and the mandates that they have today. The idea of giving them a third mandate when they haven't managed the first two very well, I think is a ridiculous notion. If we look at where the inflation rate is today, 8.6%, and how we got there and the Fed policies that got us there in part, why do we believe that adding another mandate to that is something that they would effectively manage? And it really begs the question, well, what were the reasons back here that the Fed kept rates at 0% for so long last year? And as we were talking about, buying mortgage bonds month after month, helping drive the cost of housing up and up and up and create a second housing bubble. What was the reason the Fed was doing that? What was the underlying reasons? They saw all the data we saw. They never really gave a good explanation for why they were doing it. That changed really last fall when Powell kind of slipped up and said, gave some remarks that would suggest why they were doing that. And so we have to back up here. In 2020, there was no mandate created to change the Fed's Fed policy and add a third mandate, but the Fed on its own decided they were going to start using what they called inclusive monetary policy. So instead of simply conducting monetary policy for the benefit of all Americans, they were going to break down the US into different racial groups and see if they can help certain racial groups by their monetary policy, which is, of course, again, a ridiculous assumption that by a different level of interest rate would help certain racial groups or hurt other racial groups. Absolutely asinine assumption that they made, but that is the case that they made. And Powell said one reason why that they were hesitant to reverse their low interest rate policies, even as inflation spiked at 3-decade highs, was this diversity and inclusion. And he went to a conference and stated as such that they were going to leave monetary policy easier for longer to help certain racial groups, and those racial groups were minority groups. The interesting thing about that I wrote at the time were that any study that's ever been conducted on monetary policy or inflation has found that higher inflation rates disproportionately hurt lower income people and minority groups. So this is just one study in 2021. Bank of America shows inflation hits communities of color more than others. And so This should not come as a surprise. We all knew this, and this is what now actually Jerome Powell is saying today. He's finally recognizing this. He's saying something very different than he said last year. But this is an illustration of why, another reason why, if it wasn't enough that you don't believe that race shouldn't be a factor, you shouldn't be trying to pick certain racial groups and help them to the detriment of others, even if that is possible. And I think it's a stretch to say that it would be possible. Even if you believe that the Fed should do that, this is evidence as to why it might backfire, because they might not get it right, and they've certainly got it wrong thus far. If their intention was to close that gap by having easy money and high inflation for this long, it's actually widened the gap that they were suggesting that they were helping to close. So just to sum it up here, in terms of Fed becoming a political party here, the Fed not only in 2020 started this inclusive monetary policy, they also started talking about climate change and how that was now under their purview as well. Powell said in one of the meetings, and he doesn't seem to talk about it anymore in the recent FOMC meetings, but there were a number of meetings where he espoused his views on climate change, saying they had a role in climate change. And that role was a regulatory role. And so they made the case that there was a financial risk to these institutions because of climate change. And whatever your view is on the subject of climate change, there's a big debate back and forth of what we should do about it. And there's different opinions. But I think we should all agree that the Federal Reserve shouldn't be a part of that it shouldn't be independent party, that body that's not appointed, not elected by the people, that should be deciding this. And the notion that they're going to regulate banks and try to force certain actions based on views on climate, I think it sets obviously a dangerous precedent for a number of reasons. And so we should all hope that this bill doesn't become law, that the Senate does not pass this bill. The White House, of course, has said that they want this bill to be passed, but hopefully it won't. And even if it is, I assume in the future at some point it would be overturned. It would be a disaster for the American people to have this codified and to really inserting racial-based preferences into the Federal Reserve is illogical, unconstitutional, and not good for anyone. So I said my piece on that. I encourage you all to go and read the bill yourself and make your own decisions, and try to keep an open mind in both directions and understand the implications. Even if you agree with those policies, generally speaking, is it a good idea to have them at the Federal Reserve? So I want to end here with a real positive sign on the inflation front. And a few things we're seeing there, very encouraging. Let's start with fertilizer. And I've talked about the correlation between fertilizer prices and food prices. And it's a remarkably tight correlation. And so the fact that fertilizer prices are coming down here in recent weeks is a very good sign. And we're seeing just recently food prices start to follow: corn, wheat, soybeans, all down over 20% from their highs. And we've talked about Russia and Ukraine being a major exporter of wheat. And so the more this goes down, the more helpful this is going to be. And we don't want to see problems with hunger. And there's different views on that in terms of how bad it's going to be later in this year if these prices persist. There's within the U.S., yes, we're paying higher prices, but hunger is not yet a real issue. But in a lot of emerging market countries, it is and it will be if these high prices persist. And so this is a good sign. I hope it continues. I hope that we give more attention to it and we find every imaginable solution available to try to bring down these prices, because you don't want to see this persist for another year. It's going to lead to big problems. And so what else are we seeing on the inflation front? Used car prices, something we talk about. I've called it the used car bubble because it's just an unbelievable rise in used car prices. And it really started in 2020. It was notable during that time because you just out of nowhere, you saw used car prices start to move higher. And initially, it was blamed just on the supply side. There's no supply. But really, it became clear that it was much more than that. You just had unbelievable demand from the stimulus programs, and that coupled with the supply constraints just led to these huge increases in prices that we've never seen before for used cars. And that was a leading indicator of broader inflation to the upside. And so that started again in 2020. And here we are this year, finally seeing the rate of change go negative over the last 6 months. So I'm hoping that this is a leading indicator of lower inflation rates to come in the back half of this year. And of course, at some point, inflation will peak, but the sooner the better. And in terms of market-based inflation expectations, 5-year break-evens, hit their highest levels ever a few months ago. We've just seen a sharp move lower of late at the lowest level of the year. This is an important measure Fed looks at, a lot of people look at. And so it's a good sign to see that investors are not betting on, at least for the moment, just ever higher rates of future inflation. They are seeing some moderation of inflation rates to come. And we can debate whether that's because they think a recession's coming or not, but I'll take it as good news for now. And I'm hopeful that it will continue and will continue to put pressure on policymakers to focus on that inflation side. Again, it's going to be painful, and it's been painful in the short run, but in the long run, having a stable level of prices and having a stable supply of money is the only path to prosperity for America. So with that, we'll end today's session. Have a great week, everyone. Have a happy 4th of July. Enjoy, and we'll see you next week. Thank you.